As we sit here on this quiet Sunday, November 23, 2025, the market is currently closed, but the last confirmed closing price for Hyperscale Data Inc., ticker symbol GPUS, was exactly 25.36 cents, a figure that becomes significantly more interesting when you realize it capped off a massive Friday session where the stock rallied over 21%. When you look at a stock trading at 25 cents, the immediate instinct for most people using platforms like Robinhood or engaging in online investing is to dismiss it as just another piece of market noise or a speculative lottery ticket that isn't worth a serious look. You see, a nano-cap company with a history of dilution, a history of name changes, and a chart that looks like a jagged staircase heading into the basement, and the expectation is that this is a company on its last legs, struggling to keep the lights on while selling shares just to survive. That is the expectation. That is what the surface-level data tells you when you casually glance at your Fidelity mobile app or scroll through a SoFi active investing feed. But the reality is something far more mathematically dislocation and strange, and that is where we need to focus our attention today. The reality is that Hyperscale Data has effectively morphed into a holding company, where the value of the hard assets on the books, specifically their massive and growing Bitcoin treasury, is beginning to approach the entire market capitalization of the company itself. We are looking at a situation where the market is pricing the operating business, the data centers, the NVIDIA H100 or Blackwell orders, and the entire AI infrastructure pipeline as effectively free, or perhaps even having negative value because of the stigma attached to the ticker. When you dig into the filings released just days ago, you see a company that has explicitly stated its Bitcoin treasury represents approximately 94% of its market cap. Think about the absurdity of that ratio for a second. If you walked into a bank and they told you that for every dollar you deposit, they have 94 cents of liquid gold sitting in the vault backing it up, plus a fully operational business running on top, you would be listening very closely. That is the setup we are watching with GPUS right now. It is an arbitrage play between the sentiment of a beaten-down penny stock and the hard math of a balance sheet that is getting stuffed with cryptocurrency just as the broader crypto market is heating up. The price action we saw on Friday, that 21% rip to close at 25.36 cents, was not just random volatility. It coincided with a significant volume spike with over 42 million shares changing hands. This tells us that the market is finally waking up to the fact that the selling pressure from their recent at-the-market offering, or ATM, might finally be exhausted. For those of you who track technicals on an interactive broker's trading platform or use the advanced charting tools on Schwab Intelligent Portfolios, you know that when a company finishes a massive dilution program, the artificial ceiling on the stock price is removed. Hyperscale Data recently announced the completion of a $125 million equity program. While that dilution was painful for long-term holders and is the reason the chart looks the way it does, the completion of that program changes the psychology of the trade entirely. The supply hose has been turned off, or at least tightened significantly, right at the moment when the company is pivoting to a Bitcoin-anchored strategy. This creates a vacuum where any positive news or any tick upward in the price of Bitcoin can send the stock moving violently to the upside, because there isn't a massive wall of new shares being printed to absorb the buying pressure. We have to talk about the specific mechanics of what they are doing, because it is different from your standard miner. Most Bitcoin miners are purely operational plays. They mine coins and sell them to pay for electricity. Hyperscale Data is taking a different route, one that feels more like a micro-strategy approach, but applied to a micro-cap infrastructure play. They are hoarding the Bitcoin. They are explicitly targeting a treasury of $100 million in digital assets. As of their last update just a few days ago, they were sitting on around $72 million in Bitcoin and cash allocated for Bitcoin. When you consider the market cap is hovering under $100 million, you start to see the discrepancy. You are buying $1 of assets for roughly $1 of equity, but you get the potential upside of the AI data center business for free. This is the tension that makes this stock so fascinating right now. The market expects a rug pull because that is the trauma of the microcap sector, but the reality is a company that is capitalizing itself to the teeth with the hardest asset in the crypto space. Let's pause on the recent trading dynamics because the volume we are seeing is indicative of a rotation. We are seeing days with 30 million, 40 million, sometimes 60 million shares traded. This is not retail traders on the Robinhood app flipping a few $100. This represents a churning of the shareholder base. The exhausted retail investors who bought in higher are likely capitulating, selling their shares to newer, more aggressive speculative funds or high net worth individuals who are looking for high beta exposure to the AI and crypto narrative. It's a classic capitulation transfer. When you look at the sector momentum, we are in a unique window where both the Trump trade favoring deregulation of crypto and the AI boom favoring massive power-hungry data centers are converging. Hyperscale data sits right at the intersection of these two massive macro trends. They have the legacy mining fleet, which gives them the crypto exposure, but they are aggressively retrofitting and expanding their Michigan facility to host high-performance computing workloads. This brings us to the AI component of their name. Changing the name from Alt Alliance to Hyperscale Data was a clear signal of intent, and cynical investors might call it a marketing gimmick, but the capital expenditure backs it up. They are buying NVIDIA GPUs. They are upgrading the power infrastructure. In the world of data centers, power is the new oil. You can have all the NVIDIA stock exposure you want, but if you don't have the megawatts to turn those chips on and cool them down, you have nothing. Hyperscale Data has capacity. They have a facility in Michigan that is currently being expanded. The ability to switch between mining Bitcoin when network difficulty is high and AI demand is low, or renting out compute for AI when spot prices for GPU instances are high, is the holy grail of flexible data center economics. It's a hybrid model that very few companies have successfully executed, but if they pull it off, the re-rating of the stock could be violent. The market currently values them like a distressed miner. If they get re-rated as a Tier 3 AI data center operator, the multiple expansion would be significant, even without a change in the underlying financials. I want to take a moment to ask you guys a question because this strategy is controversial. Do you think holding 90% of your market cap in Bitcoin is a brilliant Treasury move for a small company, or is it too risky given the volatility? Comment below, Treasury genius or too risky, because I really want to gauge how the retail sentiment is shifting on this kind of corporate balance sheet management. Now let's look deeper into the company's recent filings regarding their preferred stock. This is a nuance that often gets lost when you just look at the ticker on a Fidelity Wealth Management dashboard. Hyperscale Data has a complex capital structure, with Series D and Series E preferred shares. They just declared dividends on these shares again. This is crucial because it shows that despite the common stock price being in the gutter, the company is maintaining its obligations to preferred shareholders. It signals a level of cash flow management that contradicts the imminent bankruptcy thesis that bears often float. They are paying out cash. They are buying Bitcoin. They are buying GPUs. This is not the behavior of a company that is winding down. It is the behavior of a company that is aggressively repositioning itself. The completion of the ATM offering was the fuel tank being filled. Now the vehicle is trying to drive. The business model requires a bit more explanation for those who are not familiar with the intricacies of hyperscale computing. In the old days, a data center was just a cold room with some servers. Today, with the rise of generative AI, the density of power required is astronomical. A rack of traditional servers might consume 5 to 10 kilowatts. A rack of NVIDIA H100s or the upcoming Blackwell chips can consume 40 to 100 kilowatts. This requires specialized cooling, often liquid cooling, and massive electrical substations. Hyperscale Data's facility in Michigan is positioned to handle this high-density compute. By pivoting from pure Bitcoin mining, which is also energy-intensive but less sensitive to latency, to AI compute, they are moving up the value chain. Bitcoin mining is a commodity business. You compete on cost of power alone. AI compute is a service business. You compete on availability, reliability, and hardware specs. The margins on AI compute are currently much higher than mining, but the capex to get there is brutal. This is why the dilution happened. They effectively sold equity to buy the hardware to enter the high-margin AI game. The bet investors are making now is that the transition is complete enough to start showing up in the revenue lines in 2026. We also need to discuss the sum of the parts valuation. The company has mentioned plans to divest its holding company